PIA, average index monthly earnings, family maximum, currently insured, auxiliary benefits, the COLA. Social Security is laced with specialized terms, abbreviations, acronyms. While it's true in general that before one can proceed very far in gaining an understanding of a new field, one must master its core vocabulary, with Social Security that is imperative. Even the most basic explanations about how the program functions come wrapped in puzzling language, or familiar words like retirement being used in a way that indicate a technical meaning. And confusion about Social Security's terminology can quickly lead to confusion about essential elements. The aim of this presentation is to introduce the core vocabulary of Social Security, its most important specialized terms, abbreviations, and acronyms. From the outset, Social Security, initially Old Age Insurance or OAI, but soon Old Age and Survivors Insurance, OASI, and eventually Old Age Survivors and Disability Insurance, OASDI. From the outset, the program has been constructed within a social insurance framework. This insurance character is directly reflected in terms that are integral to benefit eligibility. To be eligible for Social Security benefits, either the benefit claimant or a relevant family member must be insured. Insured status is acquired by work in covered employment over a period of years. Different benefit categories require different types of insured status. All of them rest on quarters of coverage, as in calendar quarters. Quarters of coverage, which in some of its more recent communications with the public the agency terms credits, are gained by minimum levels of employment over time. Through this insurance framework, all Social Security benefits are contingent on there being a minimally sufficient period of past work covered by and consequently also taxed by Social Security. The types of work covered by Social Security and taxed have been steadily expanded since the program was first established, to the point that today most work performed in the United States, most but not all, as well as most work performed abroad by U.S. nationals, is covered. That includes work in one's own business, self-employment. Covered work is subject to the taxes that fund Social Security. Covered work counts toward insured status so long as the earnings it generates exceed the threshold for earning a quarter of coverage. A quarter of coverage represents, at least conceptually, a calendar quarter during which covered earnings exceed a minimum amount. But since the late 70s, the number of quarters of coverage credited for a year, not exceeding 4, of course, have been determined on the basis of annual earnings without regard to when, within the year, that total was earned. This central eligibility unit, the quarter of coverage, is set quite low, so that modest earnings spread over a few years can produce insured status, and since the calculation rests on annual earnings, work during a small portion of any one year, the summer months for example, can generate a full 4 quarters. Quarters of coverage, sometimes referred to as QCs, or simply credits, are used to determine whether the beneficiary, or critical family member, has the requisite insured status. Depending on benefit type, that may require fully insured status, currently insured status, or insured status for disability benefits. In addition, the agency sometimes uses the phrase permanently insured to identify workers who have acquired sufficient quarters of coverage for fully insured status, not just for the present, but whether or not they continue to work. Old age insurance, retirement benefits, and most survivors' benefits require fully insured status. Historically, the test for fully insured status was increased for successive cohorts, but for workers reaching 62 in 1999 and thereafter, it is held steady at 40 quarters of coverage. That can be achieved in 10 years of covered work. Workers who die before age 62, giving rise to survivors' benefit claims, can qualify for fully insured status with fewer quarters. the exact number depending on their age at death. Currently insured status is based on recent work in covered employment rather than a long period. A worker with 6 quarters of coverage out of the last 13 prior to the point at which eligibility is being determined is currently insured. In short, enough covered work spread over the past 3 years will give rise to currently insured status. A limited set of benefits are available to the survivor of a worker who was not fully, but was nonetheless currently insured. These include survivor's benefits for children, benefits for a surviving spouse caring for children, and lump sum death benefits. Finally, disability benefits have their own distinctive insured status test. It builds on the fully insured test, but also requires recent work in covered employment, recent in relation to when disability arose. Insurance terminology not only surrounds Social Security eligibility, it figures prominently in benefit amount calculations. The key benefit figure from which virtually all payments are derived is the insured individual's primary insurance amount, or PIA. The primary insurance amount rests, in turn, on a measure of the individual's level of past covered earnings, termed the Average Indexed Monthly Earnings Figure, or AIME. Once benefits have begun, a calculation unrelated to past earnings adjusts the benefit amount on an annual basis to keep pace with increases in the cost of living. This is the COLA, the Cost of Living Adjustment. Finally, there is a connection, at least for younger individuals, between benefits and continuing earnings. All events against which Social Security insures are life events that threaten earnings, and so long as earnings are not seriously diminished, so the program logic goes, benefits are not required. Prior to the individual's full retirement age, a retirement test operating through an excess earnings formula adjusts benefits in relation to ongoing earnings. As I've indicated, the covered worker's primary insurance amount, or PIA, is the starting point for nearly all benefit calculations. It is, first of all, the monthly benefit to which a retired worker is entitled if she or he begins benefits at the program's full retirement age, a benchmark age that is different for successive cohorts of retirees. The PIA is also the monthly benefit amount for a disability insurance recipient. In the case of a retirement or old age benefit, the monthly benefit may in fact be greater or smaller than the PIA, depending on the age at which the benefits were started. But that age adjustment is made in relation to the primary insurance amount. Benefits for family members, spouses, children, parents, are all stipulated in relation to the worker's PIA, some percentage of the worker's PIA. For example, the base benefit for a surviving spouse is, today, 100% of the deceased worker's primary insurance amount. Again, subject to adjustment based on the age at which the surviving spouse begins benefits. The base benefit for a child of a disability benefit recipient is, by contrast, 50% of the disabled worker's PIA. The primary insurance amount is calculated so as to reflect roughly, although not precisely, the worker's covered earnings over his or her working lifetime. Higher levels of earnings produce higher PIAs. Earnings are not averaged without regard to when they were acquired, thus they are said to be indexed. Earnings from early periods of the worker's life are adjusted upward to take account of general national increases in earnings levels. The indexing year for a worker is the year 2 years prior to his or her year of eligibility, 2 years prior to assure the necessary national wage data will be available. Thus it is an average indexed monthly earnings figure from which the PIA is derived. Another important feature of this average index figure is that for many workers it includes fewer years of covered earnings than they in fact have. Only 35 years, for example, in the case of a retiree who may have worked 40 years or more. To the extent that there are surplus years with actual earnings, the years with the lowest indexed figures are left out of the AIME, Average Indexed Monthly Earnings calculation. If there's a period of disability, the so-called disability freeze will also remove it from the calculation. On the other hand, individuals with fewer years of covered earnings than called for by the AIME formula will have an average reduced by the resulting number of zeros. The average index monthly earnings figure is converted to the individual's primary insurance amount by applying a series of multipliers to successive levels. These graduated multipliers are designed to produce relatively higher benefits in relation to earnings for low earnings worker than those with higher amounts of AIME. The very first band of AIME generates a 90% return in PIA, while incremental indexed earnings at the very top band only generate a 15%. The boundaries between these bands in which different multipliers operate are known as bend points, and they are among the program parameters automatically adjusted each year. The central feature of this formula to hold on to for now is that it produces greater earnings replacement for those with lower average index monthly earnings. Indeed, there is a special PIA formula for steadily employed low-income workers. When first established, the Social Security program was almost exclusively a retirement benefit program. It provided monthly benefits to covered workers who had reached the age of eligibility, then 65, and who had retired. The program has, in the intervening years, been expanded to include 2 additional types of benefits. It now includes benefits as well for workers who cease working because of severe disability long before they reach retirement age, and it provides benefits for others who have a family connection to a covered worker in the event of the worker's retirement, disability, or death. This current full range of benefits is often divided into 2 categories that distinguish between benefits paid to the worker him or herself and benefits paid to family members. The first category, retirement benefits and disability benefits, are denominated primary benefits, and the second category, benefits paid to others on the worker's account, secondary or derivative or auxiliary benefits. Secondary benefits can be further subdivided into categories based on the event in the worker's life that triggers benefits and on the nature of the family relationship. As secondary benefits were added to the system, they created a potential for wide disparity in the total monthly payments made on the basis of similar wage records. The program's solution is a family maximum that caps the total benefits paid per month on the record of a particular covered worker. That maximum is calculated from the primary insurance amount. As with the PIA formula, the family maximum calculations involves applying different percentages to different dollar ranges of the PIA, and like the PIA, the maximum is adjusted annually to reflect cost of living changes. Next, several ways to think about the numerous types of Social Security benefits.